Homeownership can feel like a dream until that annual tax bill arrives. Every year, tens of thousands of families open envelopes revealing property taxes so massive they rival mortgage payments. You might be one of them, clutching your head as you wonder how your hard-earned equity is being siphoned off by skyrocketing local levies. In today's video on the Globe Realty, we're peeling back the curtain on the top 10 states where property taxes are bankrupting homeowners in 2025. Stick around as we count down these tax titans, dissect the hidden drivers behind the pain, and reveal expert tips to protect your wallet. Hit that like button, subscribe, and ring the bell so you never miss a critical real estate insight from the Globe Realty. And let's dive right in. Number 10. Washington. As of July 2025, the median assessed home value in King County sits around $780,000. And with an effective rate of approximately 0.72%, homeowners are staring down annual bills near $5,600. Yes, you heard that right. Over $5,000 every single year. Right now, I'm tracking the latest levy lid lifts popping up on ballots in cities like Bellevue and Redmond. These measures may seem innocuous, touted as essential school improvements, but they quietly ratchet up your tax rate by a few tenths of a percent each cycle. Did you catch that recent 0.2% increase proposal? If passed, it'll tack on nearly $1,500 more to the average homeowner's tab. Here's what's happening on the ground. Rapid tech sector growth has driven property values through the roof. Yet there's no state income tax to offset the burden. Local districts are doubling down on property levies for everything from road repairs to teacher salary boosts. And many homeowners aren't taking action. They assume the assessment is locked in. So let me ask you, have you filed an appeal this year? If your home's market value has climbed unrealistically, an appeal could cut your bill by hundreds. And what about exemptions? Washington offers a senior citizen discount and a disabled veteran waiver. Are you leveraging those? Number 9. Rhode Island. In the smallest state by geography, homeowners are grappling with some of the steepest tax hikes per square mile. As of mid-2025, Rhode Island's median home value stands at $369,000, paired with an effective tax rate of 1.32%, resulting in an average annual bill of about $4,900. But those headline numbers only tell part of the story. This spring, local councils approved a 5.85% levy increase for the upcoming fiscal year, down from initial proposals, yet still enough to add $280 to the typical homeowner's tab. Without a state-level circuit breaker to cap these hikes, every incremental bond measure, from fire district upgrades to school renovations, lands squarely on your balance sheet. Meanwhile, the latest reassessment cycle bumped property values up by as much as 10% in coastal enclaves like Newport and East Providence. In those hotspots, effective rates can soar beyond 1.48%, translating to bills north of $5,500 annually. For residents who've recently upgraded their waterfront views, that extra tax bite can outpace inflation and eat into discretionary income. Have you checked whether your municipality offers a homestead exemption, senior credit, or disabled veteran waiver? Surprisingly, many eligible homeowners never submit applications, leaving hundreds of dollars unclaimed each year. And if you believe your assessed value overshoots current market conditions, an appeal could yield significant relief, but only if you take the initiative. What's your strategy this season? Filing for every available exemption? Launching an appeal? Or voting no on non-essential bond measures? Share your approach in the comments. Your tactics could be the roadmap fellow Rhode Islanders need to protect their equity. Number 8. California. California homeowners often boast about capped annual assessment increases under Proposition 13, but the reality is far more nuanced and costly. As of March 2025, the statewide median price for an existing single-family home has surged to $885,000, up from $789,000 a year earlier. With an effective property tax rate of just 0.68%, that still produces an average annual bill of approximately $6,015 per household, among the highest in the nation. Here's the policy catch. Prop 13 restricts reassessments to a maximum 2% increase in taxable value per year, but only until a property changes hands. In high turnover markets like Los Angeles County, median value of over $1 million, every sale resets the base assessment to market value, instantly inflating that 1% levy to match current prices. Then add on voter-approved bond measures for schools, wildfire mitigation, and infrastructure, which can tack on another 0.2 to 0.3 cent, and the so-called capped rate can feel anything but capped. Consider local ballot measures. In many Bay Area districts, recent school bond referenda passed with more than 60% support, funneling hundreds of millions into renovations, but also driving typical homeowner bills up by $400 to $600 annually. In wildfire-prone zones, special parcel taxes for utility hardening and emergency services now appear on your tax statement under technical voter approval provisions, and those can add $200 to $350 more each year. Have you scrutinized your county's recent bond measures? Or checked whether a standard homeowner's exemption, up to $7,000 off assessed value, has been properly applied on your property? Many Californians simply assume Proposition 13 shields them completely, but without proactive appeals or exemption filings, escalating home values and supplemental assessments will keep pushing your tax tab higher. What steps will you take this season? Voter vigilance, exemption audits, or targeted appeals to navigate California's Prop 13 paradox? Share your strategy in the comments. Number 7. Vermont. Vermont may conjure images of rolling green mountains and maple syrup, but its property tax landscape delivers a different reality. As of July 2025, the median home value in Vermont is just $200,000, yet the median annual tax bill stands at $3,850, driven by an effective rate of 2.11%, more than double the national average. In a state where modest property values meet high local levies, the math quickly turns homeowners' budgets upside down. This isn't just about headline rates. Vermont's small towns depend heavily on property taxes to fund essential services, from rural school districts and volunteer fire departments to road maintenance across winding country lanes. When your neighborhood school board approves a new bond for classroom renovations, or your town votes to beef up snowplow fleets, the cost lands squarely on your tax statement. Meanwhile, declining populations in many rural counties shrink the tax base, amplifying each homeowner's share of the bill. Ask yourself, have you reviewed your municipality's most recent revaluation cycle? In several counties, assessments jumped by 10 to 12% last year to reflect rising market pressures in nearby urban centers. Yet there's no statewide circuit breaker to cap your liability. And while Vermont offers a $20,000 homestead exemption, many eligible homeowners never apply, leaving potential savings on the table. Whether you own a quaint farmhouse outside Montpelier or a condo in Burlington, the stakes are the same. Every bond measure, every mill rate tweak, every revaluation carries real dollars out of your pocket. Drop a comment below. What strategy will you use this season? Appealing your assessment, applying every exemption, or voting no on non-critical measures? Your insight could be the lifeline another Vermonter needs to protect their equity. Number 6. Illinois. In 2025, the average Illinois household is staring at $6,285 in annual property taxes, more than double the national average of $2,970. This staggering figure stems from a statewide effective rate of 2.11%, nearly twice the U.S. norm. Here's the on-the-ground reality. Whether you live on Chicago's north side or in a Joliet suburb, those mill rates bite hard. In McHenry County, home to crystal-clear chain lakes and commuter towns, taxpayers shell out over $7,100 yearly, thanks to a 2.61% effective levy. Meanwhile, DuPage County residents face bills north of $7,600, as funding shortfalls for schools and pensions drive up local levies. What's fueling these hikes? Illinois' reliance on property tax revenue spans everything from teacher pensions to public transit bonds. Voter-approved referenda pour hundreds of millions into the system each cycle, but every dime lands on your bill. Add the state's flat income tax and soaring healthcare and infrastructure costs, and property levies become the go-to revenue source. Have you taken a hard look at your exemptions? Veteran and senior citizen credits can slice off hundreds, yet many eligible homeowners never apply. And if your assessment doesn't match your neighborhood's recent sales, an appeal could trim your bill by 5 to 10%. So here's the burning question. Will you sit back as Illinois' tax machine keeps spinning, or will you challenge the status quo? Drop your strategy in the comments. Your approach might just spark the idea another Midwesterner needs to keep more of their hard-earned equity. If you have been following so far, smash that like button, subscribe to the Globe Realty, and ring the bell so you never miss a money-saving real estate update. Number 5. Massachusetts. Mid-2025 data shows the Commonwealth's median home value at $492,600, paired with a median annual tax bill of $5,844, about $3,444 more than the national average, and an effective rate of 1.23%. For Bay State homeowners, that bite from your wallet can feel relentless. Here's the twist. Massachusetts offers a circuit breaker tax credit, refundable up to around $1,200 for eligible seniors and disabled residents. But no broad cap shields the majority of homeowners. Every ballot measure, from citywide school renovation bonds in Boston to water system upgrades in Worcester, lands directly on your property bill. In fact, in many suburban districts, recent school bonds added 0.15 to 0.25% to local mill rates, equating to an extra $750 to $1,200 annually for the average homeowner. Have you checked whether your town uses odd-even assessment cycles? Some municipalities reassess property values every 3 years, while others do it annually, meaning your neighbor might see no change one year, but you could face a full market value reset. And with housing demand still outstripping supply in urban centers, reassessments lately have sparked 8 to 10% valuation jumps in communities like Cambridge and Newton. So what can you do? First, verify if you qualify for the senior or veteran circuit breaker credit. Second, review your latest assessment. If values overshoot comparable sales, an appeal could save you 5 to 7% on your bill. And third, scrutinize upcoming bond measures. Is that new library or police station truly worth the cost? Drop a comment below. Which relief option will you pursue? Credit applications, appeals, or voting down non-essential bonds? Share your insight in the comments. Number 4. New York. New Yorkers are facing a particularly harsh reality in mid-2025. The median annual property tax bill has climbed to about $5,938, which is $3,538 more than the national median, driven by an effective rate of 2.39% on a $255,644 median home value. Yet these headline figures mask a fractured landscape where borough and county lines mean wildly different tax burdens. In New York City, for example, Class 1 homes, small family houses, are assessed at just 6% of market value before applying a 20.085% rate, effectively keeping many townhouses in the 1.2% range of market value. But step outside the city and the picture shifts. Nassau County homeowners average bills above $9,000, while Westchester County pushes $11,000, thanks to mill rates that top 2.5% and voter-approved school and park bonds. Upstate, counties like Allegheny and Orleans shoulder effective rates above 2.95%, the very highest in the nation, forcing bills over $6,500 on properties valued below $225,000. And it's not just numbers. A recent Business Insider spotlight on high-end condos revealed that even a $238 million Central Park residence pays only $841,000 annually, while moderate neighborhoods in the Bronx and Queens face bills that can eclipse $7,000. So here's your challenge. Have you mapped your own tax hotspots? Are you taking full advantage of the STAR exemption, senior credits, or co-op and condo abatements? And if a recent reassessment feels inflated, will you appeal before the deadline? Number 3. New Hampshire. Here's the lowdown on New Hampshire in July 2025. With no sales tax or broad-based income tax, the state leans almost entirely on property levies. The median home value of $300,000 carries an effective tax rate of about 1.91%, yielding a median annual bill of $15,895. That's $3,500 above the national median. What you don't see at first glance is the wild variation by county. In Rockingham County, the state's economic engine, homeowners shell out a staggering $7,265 on average each year, nearly $2,000 more than the state norm. Contrast that with Coos County up north, where the median tax bill dips to $3,350 thanks to lower property values. But here's the catch. Every school district bond, every fire department parcel tax, and every highway maintenance levy goes directly on your bill. Last cycle saw 2 to 3% mill rate hikes to fund teacher raises and rural road paving, expenses that drain wallets in towns from Concord to Lebanon. Have you filed for New Hampshire's disabled veteran or elderly exemptions? Many homeowners never submit these applications, forfeiting hundreds, even thousands in relief. And if you believe your assessment overshot your neighborhood's recent sales, an appeal could shave off 5 to 10% of your tax tab. Here's a question for you. Will you scrutinize the next levy referendum, pursue every exemption, or launch an appeal to push back against New Hampshire's property tax reliance? Drop your plan in the comments. Your strategy might just guide another Granite Stater through this tax maze. Number 2, Connecticut. Here's a briefing straight from Hartford County's tax assessor. In mid-2025, the median home value in Connecticut sits at $190,000, yet the median annual property tax bill soars to $6,162. That's a 3.14% bite out of home value, more than triple the national average. Why the sticker shock? Connecticut funds 3/4 of its public education through local property levies. Every classroom renovation, teacher pay increase, and special education program is paid by you. In towns like Hamden and Wallingford, mid-2025 revaluations sent assessments up by 45 to 55%, fueling $2,500 to $3,000 tax hikes on longtime residents. But it's not just school bonds. Municipalities tack on fire district fees, sanitary district levies, and infrastructure bonds, often bundled together on your ballot in jargon-heavy resolutions. How many of those did you vote on last spring? And did you realize each yes translates into hundreds of additional dollars on your bill? Connecticut does offer a homestead credit, up to $15,000 off assessed value, and a circuit breaker for seniors, but uptake is staggeringly low. Analysts estimate that well over 30% of eligible homeowners never apply, leaving $400 to $700 per household unclaimed each year. Here's the critical question. Are you treating every levy referendum like a line item in your own budget? And when assessments balloon, have you challenged the new valuation? An appeal, backed by recent comparable sales data, can trim bills by 5 to 8%, which adds up to $300 to $500 in real savings. Drop your strategy in the comments. Will you scrutinize your ballot closely next cycle, file for every exemption, or mount an appeal to push back against Connecticut's classroom funding squeeze? Your approach could be the game changer another homeowner needs right now. Number 1, New Jersey. At the top of the list is New Jersey, where homeowners endure the nation's heftiest property tax load. As of mid-2025, the effective tax rate averages 2.33%, more than double the U.S. norm, pushing the median annual bill over $9,300 for the typical household. Meanwhile, the median home value clocks in around $282,900, meaning families are parting with nearly $700 to $200 more each year than the national homeowner. Why is New Jersey such a high tax trap? Unlike states that offset property levies with robust income or sales taxes, the Garden State depends heavily on local assessments to fund sprawling public school systems, municipal services, and county bonds. In affluent Bergen and Middlesex counties, homeowners routinely face six-figure assessment jumps, and every yes vote on school or infrastructure referendums translates into hundreds of extra dollars tacked onto your next tax notice. Here's the live challenge. Have you scrutinized your municipality's most recent assessment? Many New Jersey residents assume their valuation is locked in, but a well-timed appeal, supported by comparable sales data, can trim your tab by 5 to 8%, potentially saving $500 to $700 annually. And don't overlook relief programs like anchor credits or senior freezes, which thousands leave unclaimed each cycle. Drop your strategy in the comments. Which move will you make to tackle New Jersey's tax gauntlet? Your insight could be the difference between a six-figure bill and meaningful savings. And that's our deep dive into the top 10 states where property taxes are bankrupting homeowners in 2025. From New Jersey's record-breaking bills to Washington's tech-driven spikes, you've seen the hidden forces driving these massive levies, and you've got the strategies to fight back. Now it's your turn. Which state's tax burden hit you hardest? Drop your story or your go-to relief tip in the comments below. Your insight could save someone thousands. If you found this video valuable, smash that like button, subscribe to the Globe Realty, and ring the bell so you never miss a money-saving real estate update. Thanks for watching, and here's to keeping more of your hard-earned equity in your pocket. See you next time.